Warren Buffett, 12 investing mistakes that cost people money. When people think about successful investing, one name almost always comes up first: Warren Buffett. For more than half a century, Buffett has built one of the greatest investing records in history. Not because he predicts every market move, not because he chases the latest trend, and not because he takes crazy risks. In fact, Buffett's success comes from something much simpler. He avoids mistakes over and over again. While many investors focus on finding the next big winner, Buffett focuses on avoiding the decisions that destroy wealth. And that's an important lesson. Because in investing, making a few good decisions can help you. But avoiding major mistakes can completely change your financial future. Today we're looking at 12 investing mistakes that cost people money every single year. Mistakes that keep investors stuck. Mistakes that create unnecessary losses.
And mistakes that Warren Buffett has warned about for decades. Let's begin. Mistake number 1. Investing in something you don't understand. This sounds obvious, yet millions of people do it. They hear about a stock online, a friend recommends it, a YouTube video hypes it up, social media starts talking about it, and suddenly they invest money without understanding what the business actually does. Then the price drops. Panic begins, and they sell. The problem wasn't the investment. The problem was ignorance. Buffett has always emphasized understanding what you own, because when you understand an investment, you make better decisions during difficult times. Knowledge reduces fear, and fear is one of the biggest enemies of investors. Mistake number 2. Chasing hot stocks. Every market cycle creates excitement. A certain stock becomes popular. Everyone starts talking about it. Headlines appear everywhere. Success stories spread rapidly, and people become convinced they are missing out. This is where FOMO takes over. Fear of missing out. Instead of asking, "Is this a good investment?" people ask, "How quickly can I get in?" That mindset is dangerous because when excitement becomes extreme, prices often move far ahead of reality, and investors who arrive late frequently pay the highest price. Mistake number 3. Trying to get rich fast. The dream of getting rich quickly has probably cost investors billions of dollars, because fast wealth sounds exciting. Slow wealth sounds boring. But history repeatedly shows the same lesson. Most sustainable wealth is built gradually, not instantly. The problem with chasing quick riches is that it often encourages unnecessary risk. People stop thinking long-term. They stop thinking logically. And they start gambling instead of investing. Buffett became wealthy through patience, not speed. Mistake number 4. Buying high and selling low. This sounds ridiculous, yet people do it constantly. Why? Because emotions take control. When prices are rising rapidly, people feel confident, optimistic, excited. So they buy. When prices fall sharply, people feel nervous, scared, uncertain. So they sell. The result? Buying high, selling low. Exactly the opposite of what creates wealth. This cycle repeats every market downturn, and it continues costing investors enormous amounts of money. Mistake number 5. Ignoring the power of compounding. Many people underestimate how powerful time can be, because compounding looks slow at first, very slow, sometimes painfully slow. In the early years, progress seems almost invisible, but eventually, growth begins creating additional growth, and then that growth creates even more growth. This process accelerates over time, which is why Buffett has often described time as one of the investor's greatest advantages. The earlier compounding begins, the more powerful it becomes. Mistake number 6. Checking investments every day. Most people think watching investments constantly makes them smarter. Usually it does the opposite, because frequent monitoring creates emotional reactions. Every small decline feels important. Every market headline feels urgent. Every prediction feels relevant. And before long, people begin making decisions based on noise, not strategy. Successful investing often requires patience, and patience becomes difficult when someone is staring at prices every hour. Mistake number 7. Borrowing money to invest. This is one of the most dangerous mistakes investors make, because borrowing amplifies everything: profits, losses, stress, risk, and uncertainty. Many people focus only on potential gains, but investing with borrowed money can create serious financial pressure if things go wrong. Buffett has repeatedly warned against taking unnecessary risks that could permanently damage financial security, because surviving is more important than maximizing returns. Mistake number 8. Lack of diversification. Putting all your money into one investment may feel exciting, but it can also be extremely dangerous. No company is guaranteed to succeed forever. No industry is guaranteed to grow forever. Unexpected events happen. Markets change. Technology evolves. Competition appears. Diversification helps reduce the damage caused by being wrong. And every investor is wrong sometimes, even the best ones. Mistake number 9. Trying to time the market. This is one of the most common investing mistakes. People wait for the perfect moment, the perfect entry, the perfect bottom, the perfect opportunity. The problem? Nobody consistently knows when those moments occur. Markets are unpredictable, and waiting for perfect conditions often means missing years of potential growth. Time in the market has historically been more important than trying to perfectly time the market. Mistake number 10. Letting ego control decisions. Investing becomes dangerous when people stop learning. When they become convinced they are always right, when they ignore opposing opinions, when they refuse to admit mistakes. The market doesn't care about anyone's ego, and investors who cannot change their minds when facts change often pay a heavy price. Humility is one of the most underrated investing skills, yet it can save enormous amounts of money. Mistake number 11. Focusing only on returns. Everyone wants higher returns. That's normal. But many investors focus entirely on reward while ignoring risk. They ask, "How much can I make?" instead of asking, "How much can I lose?" That second question matters a lot, because preserving capital is essential. Large losses require even larger gains to recover from. And avoiding catastrophic mistakes is often more important than finding extraordinary opportunities. Mistake number 12. Quitting too early.
This may be the most common mistake of all. People start investing. They stay consistent for a while, then progress feels slow. Results aren't exciting. The journey feels boring, and they quit. What they don't realize is that wealth often grows slowly for years before accelerating. The hardest part of investing is staying committed long enough to experience the benefits of compounding. Many people stop right before the process becomes powerful. The big lesson Warren Buffett teaches. If you study all 12 mistakes carefully, you'll notice something interesting. Most investing failures aren't caused by lack of intelligence. They're caused by emotions. Fear, greed, impatience, overconfidence, comparison, and short-term thinking. That's why investing is often more about behavior than knowledge. The best strategy in the world won't help if someone abandons it during difficult times. And even a simple strategy can produce remarkable results when followed consistently for decades. Final thought. Warren Buffett's success didn't come from predicting every market move. It came from discipline, patience, rational thinking, and avoiding mistakes that destroy wealth. Because successful investing isn't about being perfect. It's about making enough good decisions and avoiding enough bad ones for time and compounding to work in your favor. And if there's one lesson investors should remember, it's this. The biggest threat to your portfolio is often not the market. It's the emotional decisions you make when the market moves. Master those emotions, and you're already ahead of most investors.